Thank you. Yeah, my roots at SFI go back to when I ran the economics program in the early 1990s there, back when it was kind of a scruffy place, and well, I was a scruffy guy and still am, so anyway, and some of my comments will go back to these kind of earlier ideas. I think the issue here of thinking about modeling heterogeneity, strategies, model, and market behavior is something I've been thinking about for, unfortunately, a very long time. And I'll tell you a little bit about some of the overview of this and just some very quick examples of things we do know about what's going on in this world. I thought to start with, I'm not sure what questions exactly we'll be focusing on as a group, but fire these. I'm also going to make sure I leave plenty of time for you guys to fire questions at me. I'll try to guide you through a couple on sort of these things, thinking about machine learning strategies and market behavior. Then related to strategy heterogeneity, or sort of thinking about homogeneity and heterogeneity in markets, which I think is also very much related. And also we've been looking, I think, what is the world of this mixed human-machine world looking at, which we keep, bouncing on. David talked about that a lot this morning, I think, and we've been bouncing around that idea too. I guess to motivate, I'll throw you with a little picture that I've used forever. If these were oat-style overheads, this one would have kind of brown sides on it. I only want to point out that the point is sort of obvious. What's interesting, I will draw, I don't know if you can see it up on the font, this is from The Economist. The date is September 17th, 2005. So this was, as someone said, this has been sort of in the lore since the 90s of sort of debating what this is. I would use this, but I've used this slide with a different purpose as I move through time. I used to try to use it as to motivate, well, we were trying to model humans with computers. And then I'd sort of say, well, what's the world with a lot of humans and a couple computers? And now I think we're sort of saying, well, what's the world with maybe lots of computers and few humans? So the slide has remained the same, but its kind of context has changed over time out there. First key problem is heterogeneity. What is it? What do we really mean by it? It's some sort of dispersion across strategies or behaviors or something. At least in finance, I think in social systems in general, it immediately gets kind of complicated because it can be a good thing and a bad thing. Is it a mechanism for instability? Is it a mechanism for stability? Finance is a key place where you need some heterogeneity to get people to trade with each other. On the other hand, sort of massive heterogeneity may lead to huge swings in prices. So what are we really talking about? And also sort of what do you mean by heterogeneity? Do you mean sort of just some, forecast with a normal dispersion around it? Or do you mean, maybe distributions that are wildly non-normal, bimodal, or, all sorts of bizarre things out there? Matters. When you look actually in the world of computer simulations, all of that stuff matters. So you really have to turn to trying to think about how you're going to model these things. And that leads to the tool that I've been using for years, and we will be, has sort of come up in commentary. These are agent-based simulations, which are popular in many different areas, different social sciences. Economics, they're still, even after all this time, somewhat radical. Economics and finance, we're kind of still on the fringe after a bunch of years, but other places they're more accepted. What are these about? They're simply models of interactive that we've discussed the morning. We were talking about them all over the place, interacting agents and strategies. In finance, the price time series that come out of these things are completely endogenous, so we're looking for behavior in these kind of features, broad price or volume or any of the market features that come out. Learning is completely self-contained in these systems. Agents are learning, prices are revealed, more learning, more prices, and it's continually going on. The important thing to heterogeneity is heterogeneity in these worlds is completely endogenous. And this is sort of a commentary to a side of economics and finance to say that, like, we already have heterogeneity, we know what it's all about, we completely understand it, we wire it into our models. Well, the heterogeneity in most complex systems is not wired in, it's not the point. We're interested in it, it is the thing of study, how it moves. Of course, biological, genetic systems, totally the same sort of thing. Sits kind of front and center as the thing we're really interested in. Needless to say, this sounds great and sounds like, okay, let's go do it. Let's turn on the computer and go. And we were doing that. We were ready to go doing that. The problem is actually doing this involves some interesting methodology questions. And so the world of agent-based modeling in finance has moved in many different ways. So this is a summary of 30 years of research in one slide, not my, many people's research. And there are many ways to go about this if you think we want to try to do a financial market with these things. A large swing of the literature, matter of fact, much of the publications in it have involved fixed strategies where you kind of hardwire a few types of styles in, send it to the computer and try it. They're not, you'll still see dynamics across these different styles, but there are relatively few of them, and they're there. You can do this advantage, you can do some interesting analytics on this sort of stuff, and it has been a big area of research. I personally have not been involved in that. I don't think it captures the spirit of what we are really interested in terms of broadly building agent-based models. But it does get you some mileage in terms of simplicity. Related to it, and very interesting, and maybe kind of something you really want to think about these days, and this has changed in the world of data availability, is a more empirical style. Instead of, pulling out these kind of strategies being sort of random or thinking about them, oh, this is where traders behave, you just use empirically derived, go to the data and actually estimate different types of behavior out there, depending on how accurate, what kind of data you have. If you're doing high frequency data, if you really have access to what everybody is doing and you have, IDs on traders, which is sort of the nirvana of data, you may be able to do some of this. It can be tricky though, because not all of us have that kind of data. But it's a very, very powerful sort of tool, and it's been used in a couple different places. The markets I've been involved in is very much this second set, where the strategies are changing, dynamic, adaptive, evolving over time. And even in this world, the actual underlying machinery to use and representations and the AI representations have been varied over time. And I've actually been involved, of this set, actually been involved in 3 of them. The original Santa Fe stock market sits down here. That's the basically decade we were working on that. That used a system known as classifier systems, really developed by John Holland, who is one of the original founding entities of Santa Fe Institute. I spent my time fiddling with neural networks in the 2000s. And what I'll show you today, believe it or not, is linear forecasting systems. And there are also researchers out there who have worked on sort of maybe the monster of all evolutionary systems, something known as genetic programming, which effectively looks like evolving decision trees. Now, let me point out, in each of these systems, what we're thinking about are strategies, populations of strategies. These are not single entities out there. So in the world of neural nets, I was working with maybe between 500 and 1,000 neural nets evolving and effectively trading against each other. So we were trying here very much to build a system of trying to understand what kind of heterogeneity would endogenously appear out there in the systems. And now, final question is, why have I moved myself to more simple systems? And I think I'll show you some of that today. The linear forecast, even simple, although many of them, simple rules are quite capable of generating very realistic looking things out there for financial data. This master sea of agent-based models, what has it done for us in the last 30 years? It has a couple of its key things. It has been able to, in many ways, across the board in many of these different models. Matter of fact, too well. It's the only forecast I ever made in my life, I think, that was a good one, is I forecast that we would have too many viable agent-based models eventually, and that actually has happened. Many of them, and this is some to the mathematicians out there must be some genericity theorem we've often thought out there. Many of them replicate many difficult empirical features from financial markets. Among these, fat-tailed distributions, persistence of volatility, actually long memory-like features in volatility if you're a kind of volatility aficionado, movements in volume, trading volume, and appropriately, all of these sort of things are not too difficult. Many of these models replicate those things. They also have a sign of emergent strategy coordination. David mentioned a little bit difficult problems of emergence. I totally agree with that. I've had to fight with those. Here we were interested in what if we throw this soup of strategies together? Would they in any way coordinate with each other? Would we still see sort of a soup at the end of the day, or would they kind of lock down on certain features out there together, endogenously locked together? And that seems to happen in general. There are cases where they do, as you know, economists and financial economists, we were interested in whether they would, in certain parameter settings, converge to stable equilibrium. That also, you can do that, not in all of them, but occasionally you can do that. It doesn't happen very frequently, which might be kind of an interesting question. So let's look at all I'm going to do is show you a very simple example of one of these agent-based models, and we'll just go through it at, 20,000 feet here. It's a very simple economy, and we'll look at the agents, their forecasts, and what happens in the market. Single stock pays a random stochastic dividend, which is calibrated actually to actual data, growth and volatility. It's in finite supply. There's no new issuance, so it's a kind of closed system. Price is completely endogenous. There's a risk-free interest rate out there. I actually, just for cleanliness, have often set the interest rate to 0. I actually was doing that a while ago. It's also weird that the data has kind of converged to my model, not me. That was not my intention. It just actually, for theoretical reasons, was easier. So it should be unrealistic, but unfortunately, maybe it is. We got to move that a little bit so I can stop that joke. But the types in there also, the sea of type system has not been that useful. So I actually declare a few types that sort of line up. First, there's an adaptive expectations type in their strategy, which is a trend-following strategy. I'll point out, so all it's doing is it's a momentum strategy. But what's critical in this is time horizons. And this has come up a couple times. And this heterogeneity of time horizons is critical to me in what I do. And it's critical having some heterogeneity. And I'm going to show you that as we move along here. These forecasts are based on a potential perspective of using differing values of the past. So if these are thinking about a moving average strategy, they might be using differing moving averages. But this is very simple. I just modeled them with a forecast gain level. This is a simple adaptive forecasting system. It's related to a Kalman filter, but it's a simple, very, very simple adaptive system. There's forecast gain horizon, which determines how much of the past, how do you weight the past relative to today? That's going to be heterogeneous across the types. There's also a fundamental type that's mean reverting. It's thinking about, it knows what the dividend is. It has a sense that the price is going to return to that fundamental. It tries to figure out somewhat what is the long run price dividend ratio, but again, it has its own history. They're heterogeneous across thinking about that. You'll see that in a sec. And so they reach back across different horizons. Two other types, which are equivalently important. This has also come up. There's a set of liquidity providers. They're providing liquidity. They're super important out here. They're basically running sort of a short-term arbitrage operation. They're looking for reversals. They're going to try to fill those in. They are risk averse to some extent. And so when things get hot, they kind of pull back. They'll sort of pull out of the market and be maybe less effective at what they're doing. So liquidity, I'm trying to, liquidity is a dynamically changing object here and is very critical to the dynamics of what's going on here. Again, they're going to measure these things over different horizons. There is a long-range buy and hold type out there that's also floating around that takes a long-range means and variances. They're all actually also risk averse and are doing mean variance calculations here. They're holding portfolios, optimizing a well-defined mean variance optimization problem. That means they also have to estimate the variance. The variance is a simple adaptive forecast 2 itself. My font got screwed up on that a little bit, but actually, so this is actually your basic variance forecast. Oh, terrible, I don't know what this is. This is forecast error, so my font did not make the PC to Mac transition. Seems to be high-powered machine learning code that we still can't get from a PC to a Mac. But anyway, this is actually a simple adaptive expectations. It would be the same as a risk metrics, or if you're an econometrician, it's an Arch or Garch model for volatility. Very basic, simple volatility. It's an adaptive. But again, they're going to have different time horizons and different perspectives on time. Forecasting volatility is, because they're all risk averse, is also critical. Bottom line picture to think about what's going on here is this. That you don't really, these pieces, I hope they sort of make sense, but in each piece, there is this heterogeneity across how they view the past. Some people are using, small histories to evaluate stuff, some large, some, and there's a continually dynamic of adjusting across that. They're continually probing these to see where we should be out there. So in all of the different families, you can think of these families as looking like this, where the big blob says, oh, they're not just adaptive types out there, but they have a lot of heterogeneity across these time horizons. So a lot of there's heterogeneity across the actual strategies, but also very much across time and time horizons. And they are continually to think about this, or not think, they don't do deep thinking, but they're adapting and adjusting across these time horizons. A given market run generally will, with this picture's up there, will usually allow for a fair amount of, there is generally no convergence. If you let the market run, you will not see a convergence to a specific time horizon. I am going to, in my experiments today, will show you what happens if I, as experimental, force it down to say, okay, everybody look at 5 years. But they're generally, in the general run, you don't see that. And finally, rule choices, that's what they're doing. I just want to remind you, all the time, they're continually, the agents are waking up, looking at these strategies, trying to choose, and this is true of almost all of these agent-based models, looking and adapting and adjusting over time, continually trying to re-optimize what's going there, what they're trying to do the best they can out there. They don't have there's of course no single optimal strategy. They're only just trying to move uphill, roughly, in terms of what they're doing. A couple nitty-gritty details underneath. Their pricing actually in this model is actually a fairly new model for me because it's honed to try to operate at high speed. Compute stuff over the years has been a huge boundary for me. We really need to do these much faster, so I've been building newer technologies to move faster, uses linearized demands, uses an obscure language, but actually I love it, so I'll give it a quick sales pitch called Julia, which is extremely fast. And we will be running benchmark runs with these gain values in half-lives of 4 weeks to 10 years. So you can think that's sort of the data horizon that's kind of going. We're going to do a quick reduced heterogeneity experiment. We'll compress those gain levels down to whatever. I'll run the market for a while and then compress them down to their mean value that they've captured on that run. And you'll just see we'll see what that looks like. This is an example of these are price dividend ratios from a given run. And I like this picture because it kind of captures, aside from, I actually have a poster of price earnings ratios on my wall. That's weird, I know. But I do think there's some interesting subtleties in here that you see. I mean, if you weren't really looking at it carefully, it is stationary in the long term, but highly persistent, which of course price dividend ratio, any price fundamental is, and also settles down. You see many different sizes. You can see, of course, slow increases, big drops. I could show you much more empirical stuff on this. And sort of differing, length scales to various of these crashes sort of going on here. Settles occasionally at different levels, where that's actually part of the feature of them having different time perspectives. They're struggling to figure out what they think is the appropriate price fundamental ratio at a given time, and because they come out of different time perspectives, some of them are quite happy to sort of stay at some of these more intervening levels. If you take that out, you'll see something quite different. These are what the returns look like of that, and this is, I said, the common features that I won't give you all the statistics on. You see sort of in fat-tailed distributions, you see the extreme moves. You also see clustering of volatility. It's pretty clear, which has been one of my kind of huge features that I think we still do not well understand out there. Markets in general, these things are able to create, this is not just this market, we can do this volatility persistence, fat-tailed returns distributions, and generally uncorrelated returns. All of these are features that all these markets generate. Longer term, volatility persistence, I throw that in. It is actually, of course, a long and short-term feature. Those fundamentals do give you predictability out at the long term, as they should. Another thing, though, last little before I show you some of the other results on these, heterogeneity does not stay put in these markets over time, and that's another tricky part of it. It's moving through time. What do we mean? When we talk about heterogeneity, these are sort of the adaptive and fundamental forecasts out there. That's price-dividend ratio. What you can see, these are two sort of large corrections that go through out there in the market, and at each of those periods, these things spread apart. So the market, and actually this is true in actual human forecasting data. When we look at forecasts of market prices, when we see periods of high volatility or sort of giant sort of moves in the market, those are the periods when forecasts do spread apart on that. And so it's doing the logical thing. Now, last thing, before I wrap up, because I'll try to leave a lot of time for chatting here at the end, I promised to sort of think about this exploration of heterogeneity. I'm going to set up sort of a quick experiment. So I'm going to use that. What I've shown you before is sort of my high heterogeneity case. But let's see what happens in the computer. What we can do is actually do some counterfactuals. And I'm going to compress these forecasting gain levels. So I'm going to take those time horizons, compress them down slowly in the simulation to their average level. So see if that generates. So we take, they may be 10 years. If I look out in the population, maybe they're 5 years to 2 years into the range. We will compress it down to the average, which might be roughly 3 or something. But I'll maintain the different types. So there'll still be all those broad different families, but we'll take away the time heterogeneity. We still get movements here. These are the price-dividend ratios. They're quite different. They're quite weird. They don't really, I'm not going to argue those look all that realistic, except maybe Bitcoin or something. Which might say something, but doing, of course, something quite weird and different. The returns visually look similar. They're still sort of clumping, but actually you can see they look a little different. I'm going to show you in one sec something that shows you there is really something quite different going on. So what I thought I'd do is my last experiment, to do a little more machine learning here. Let's feed the return series into a standard machine learning system. My preferred one, actually I totally agree with the comments on deep learning and low signal to noise ratio. I use something called kernel ridge regression. I find that the most effective in sort of low signal to noise environments. It's a kernelized nonlinear regression system. I will use that, just feed in the simulated data into that, and we'll see what it does. I'm going to apply it to the weekly return series. I've been actually generating weekly return series. The benchmark runs, low heterogeneity runs, and actually, just for kicks, we'll throw in the S&P 500 ETF, the spider. And I will look at both here linear and nonlinear representations, basically running an auto regression on this. I know, very low tech. It's using, what we're looking at here is completely test set stuff coming from a 5-fold randomized cross-validation to the machine learning crew. That's what's going on. It's totally sort of fair, standard toolkits. The other beautiful thing about current machine learning is these are pretty standard toolbox things. This comes all straight out of scikit-learn, those Python users, and we'll report the mean and standard deviation of these things. Just quickly, these are out of sample R-squareds, which is basically recording what fraction am I able to forecast relative to just using the mean in the pure out of sample side. So if you look at the linear side, basically nothing in any of the three cases. Nothing, 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 0, 0, 0, almost nothing. So these are all fooling any kind of linear test. And these are, remember, these are pretty simple strategies that I was throwing in. That's actually the key message. So they were easily able to do that. The nonlinear side, the baseline model does pretty well here in terms of being fooling what's going on. It's not, that's about 6%. Obviously, way ahead of any financial series, but still pretty small in terms of picking up structure. These simple strategies competing with each other have done a pretty good job of knocking out the structure. But when we go to low heterogeneity case, that kicks up to about 20%. So true here, at least in this environment, reducing that gain heterogeneity, the time perspective heterogeneity, did cause sort of a rather big change in the behavior of the market. Unrealistic, and granted, very unrealistic change, because I would have never, I mean, totally expected this, but I mean, you would have told me my results are wrong if I ever found anything. Of course, the S&P, negative 0.06. There's no way that a simple kernel ridge is going to find something in the S&P. So of course, there's no nonlinear predictability, at least in this very simple system out there. So the bottom line here, let me just wrap up, and is one of the things we see here in the agent-based world is competing simple strategies we've seen this for a long time, generate realistic price features, and I'll kind of emphasize simple, so it doesn't even take a lot of horsepower in these strategies to generate. So this is very much in a complex system sort of spirit. These are relatively simple adaptive strategies generating a fairly rich environment. The outcome looks a little like humans. Remember, it is an adversarial environment. It's not a random, they're playing against each other like any financial system. This is a highly adversarial system. Obviously, adversarial is a big deal in machine learning these days too. So you can think of it as related to that. History matters, as people have brought up history and heterogeneity. That element of what's going on, I think, is super important. I just kind of am obsessed by that issue that I think, doesn't take, really that's all it takes to get a lot going on in these systems. Finally, questions on the table that I haven't answered that I think, are relevant too, still relevant, that I haven't answered for you. There is a lot going on with liquidity in this system. Liquidity, the dynamics of liquidity are critical. And does machine learning change, or the strategy, the way it's being utilized? It's been brought up many times today. I do think that's a super big open question. I have actually worked on some of these with limit order books operating at much higher frequency, and that question continues to sort of daunt me a little bit there. Does machine learning lead to changes in speed, faster coordination? Does things happen faster than they used to happen? I haven't really explored that. I do think, again, the speed of adaptation and learning is a kind of Achilles heel of agent-based models. It's a free parameter we have out there that we don't exactly have pinned down. Any free parameter is just like scary to us. And that's a problem. And it's really critical here. It's critical in evolutionary game theory, to the game theorists out there. I mean, very scary. The other thing that's come up many times here, and I think is important, is multiple asset strategies. I've shown you single asset. Actually, this version of the market was developed to operate at such high speed to handle problems of multi-asset markets. I think multi-asset markets are a big deal. And obviously, you guys think it's a big deal. But how machine learning, of course, methods, or AI methods, of course, easily step across markets and have no trouble. They don't care about that because they suck them all in. I mean, humans can do it, but I always think in the end of the day, they don't do it quite as well. And that's sort of, the big puzzle for me, or big challenges, are issues like crowded trading, those sorts of things, when liquidity is now involving being how things are spread across stuff. That's another very big challenge. Another part of that, sort of like when alpha becomes beta, those sorts of things are also big things out there. But thanks. I'm relatively on schedule.